Okay. In this session, let's focus on this case study on capital budgeting. The difference, if you observe between our typical budgeting case study and this, in our budgeting case study, we were focusing more on a short term, right? Whatever we have prepared as a budget is for the next 1 month, or probably the same thing could have gone for the next couple of months. So that's for a very short term focus, 1 year, within 1 year, whatever the budget we are making. Whereas when we talk about from a capital budgeting standpoint, we are talking about a big investment decision. Capital budget, right? Capital is like a big investment. In this case also we are talking about whether we should go for proposal 1 or proposal 2. Right? Proposal 1 also involves a big cost, few crores. Proposal 2 is also involving a big cost. Right, to develop that casino there are so much of, or either to develop new rooms, there is so much of cost that is involved. So that kind of capital which we are investing, a huge capital where there is a huge capital investment, to evaluate the profitability of such kind of huge investments, we follow the mechanism of capital budgeting. Right, and it would be having, let's say I have built a casino. The benefit of it could be for multiple years, not just for 1 year. The revenues, increase in the revenues can come over many years, right? Or if I am expanding, if I am building new rooms, it's just not the benefit for this current year, but I may be incurring the cost 1 year, but after that probably small maintenance expense is what I will incur. But the revenues I will be getting continuously for few more years, right? So this kind of a budgeting or evaluation of a project typically happens over multiple years. I have to visualize what are my costs, basically one time, what is my lump sum cost, right? How much lump sum cost I have to put up. For proposal 1, there is some lump sum cost. For proposal 2, there is some lump sum cost. So what is the lump sum cost? Then annual revenues, how are they increasing? Right? Though I have included one lump sum, the benefit, which is the increase in the revenues because of doing this, probably by building a casino, the extra revenues which I can get over the next few years, on an annual basis, how much revenue I can make. Similarly, on an annual basis, how much expenses are possible, and probably how much profits during each of the years. So what we are typically talking of is invest something this year. Over the next few years, I am realizing that benefit. If that is the scenario, is it worth investing that lump sum in the project? Or if I invest this lump sum, and if I am going to get this over the next 4 years, what is my return? How much percentage profit I am getting over this 4-year period or 4 or 5 years? Let's say I'll make a assumption in this case that I will look at, this investment may be valid for, let's say, 5 years or 4 years. Right? Probably you can very well look at it as 10 years also. But what may so happen is because this industry is a very dynamic one, probably after 3-4 years again you may have to remodel everything. So let's make some assumption as a part of this case that it will go for 4 years. Whatever the new rooms you are building, you don't need to do anything big for them except for their annual maintenance. You don't need to do anything big on them, and you will get your revenues for 4 years. Same way, even if you have gone for a proposal 2, we'll assume that the casino and all whatever you are building, they can be used for 4-year period. Now, if this is one assumption we are going with, then what are the various tools we can use to evaluate these kind of projects, especially where the investment is done once, lump sum. Otherwise, maintenance and regular costs, you can keep them aside. A lump sum investment is done in the beginning, whereas the benefits come at a later point in time, probably over a multi-year period. This is the typical case of capital budgeting projects. Right? Now, taking this example, how do I evaluate which of these two proposals is the best for me? Right? Now, just trying to represent the data which is already given, right? The rooms, the current scenario wise, the rooms, there are 200 economy class, 100 executive class and 25 deluxe class. Their daily tariffs are this much. So the price per day is this much. Occupancy rate is 0.4 in all of them, which is what is the total revenues, which is working out to 14 crores 70 lakhs. Fine. Occupancy rate is 40%. So out of the 350 days, 40% is the occupancy, which means probably 140 days they are booked. So per day you are getting 5 lakhs. Because there are 200 rooms, 2,500 per room. 5 lakhs into 140 days is giving you almost 70 lakhs. No, 7 crores. 7 crores. Similarly, here from this you are getting some 5.6 crores. Here you are getting 2.1 crores. Overall, your revenue is 14.7 crores just with the room rent, room tariffs. Assuming 40% is the occupancy rate, you are getting a total revenue of 14.7 crores. That's one table he has given. The second table is on the salaries. Salaries to the current staff, which has worked out to 7.3 crores. The salaries to the current staff is working out to 7.3 crores, which he has given in the case directly. Now, now you can directly go to, see, up to the current scenario, you can go to this income statement directly, which he has given. Total room tariff is 14.7 crores. So other profits, whatever he is getting, from the restaurant 1 crore, from the coffee shop 30 lakhs, from the boutique and discotheque 25 lakhs. Overall, your revenues are 16.25 crores. And your expenses are 12.3 crores. Your expenses are 12.3 crores, which means your profits before tax is 3.95 crores. On that, you are paying a tax of 35%, which is 1.38 crores. I mean, once you derive it, it is nothing but 35%, right? 1.38 divided by 3.95, around 35%. So why we are confused? Though he has given the tax is 1.38 crores, I will do it in percentage. I will find the percentage of that, because for the new profit, whatever I get, right now I have to see the modified profit with proposal 1 and proposal 2. I have to take the tax out of it. That's where I will say whatever the profit that comes out, I will take a 35% tax on it. So that will be the profit after tax. Now let's go with the proposal 1. Whenever we talk about any capital budgeting proposals, we only talk about incremental benefits and incremental costs. because the current is already there. Now the new investment which I am making is the extra. So even the revenues and the expenses and the profits, I will look at only the extra. So if someone has suggested build 100 more rooms, revenues I don't need to compute of 300 rooms. I'll compute only for that extra 100 rooms. Right? The reason being, the new investment, see, the old is already existing. It has nothing to impact my decision. But the new, extra how much revenues I am getting, extra how much costs I am incurring, extra what is my profit, because the investment is only for the extra, right? So we always work with incremental revenues and incremental costs, not the total revenue and the total cost. Only the difference, only the incremental part, only the new part, only the difference part, right? If someone is talking about demolish the total existing one, then probably we have to take it from scratch. Otherwise, we need to look at only the incremental part. Okay, let's look at the proposal 1 now. If it is the proposal 1, they are targeting, they are targeting increase the number of rooms. Economy class 100, executive class 80, and the deluxe class 25. So, if they are increased, my rooms will become something like this. 300 in the economy, 100 are increased. No, from 2 it becomes 3. After increment. 300 is in the economy, 180 is in the executive, and 50 in the deluxe. Prices are not changed. So this will be your total revenue per day. 50% occupancy. So your overall revenue is going to improve to, as per the expectations of the first consultant, your revenues are going to go up to 30.975 crores because of the new proposal. Which means what are your incremental revenues? This much. From the rooms. From the rooms, earlier he was talking about 14.7 original. But the new is talking about 30.97 crores. So the difference is 30.97 minus 14.7. The original 14.7 crores. When no modification was done, you are getting 14.7 crores from the room tariffs. But this guy has proposed to increase the rooms like this. Because of this increase, you are expecting even an occupancy to go up. So overall, you are expecting that the revenues will go to 30.97 crores. But we have to deal with incremental revenues only to evaluate our project. Which means every year, my revenues will go up by 16 crores. Or probably if I increase the price next year, it may go even more. But for the time being, we can assume that every year it will increase by 16.27 crores unless we have some other further information. So assume that we are not changing the price for the next few years. This is an annual thing only, right? Because we have multiplied it by 350 into something. So on an annual basis, this extra revenue is going to be 16.27 crores. If the original was there, every year I would have got only 14.7 crores. Because of the new, every year I will get 30.97 crores, which means every year. So this is an annual kind of a number. Every year I will get 16.275 crores extra. Now let's look at the costs. There is no other extra benefit which I get through the proposal 1. Is there any other benefit I am getting? Only the room tariff is increased and nothing else. Or room occupancy is increased, number of rooms are increased, and nothing more than that. I am not getting anything more than that with proposal 1. Benefit wise. Sorry? That is the only benefit with proposal 1. But what are the costs with proposal 1? Cost of building a casino. It's an incremental only. Everything new. Earlier there was no casino. Now I am putting some 4 crores over it. So that's a one-time cost. Right? I have to classify these costs as are they one-time or are they annual. Probably building the casino, which is there in point number 1, cost of building a casino and a ballroom, 4 crores. It's a one-time activity. Every year I will not build it. It's a one-time activity. Today only I am building it. Now only I am building it. Then what else is the cost? Cost of building rooms. How many rooms I am building like this? 100 new economy. Right? We are building 100 economy rooms, 80 executive rooms and 25 deluxe rooms extra. And economy is costing me 8 lakhs per room. So overall the whole cost is coming out to 22.6 crores. 8 crores for economy, 9.6 crores for executive and 5 crores for deluxe. So overall it is coming out to 22.6 crores as the cost of building. Even this is a one-time cost. Right? If I build it now, probably for next 4 years, they can be used. I will not build it and change it and build it and change it every year. So these two, now look at it. These two itself are 26 crores. I am incurring 26 crores, but the extra revenue I am getting is only 16 crores. But here, the 16 crores will come not for 1 year. They keep coming. Right? They keep coming. It's not a one time. Whereas these two are one time. That is where I will get the benefit. Right? Even if these are also annually repeating, then I'll say scrap the project. Because my costs are, this is where we call it as cost benefit analysis. How good are my costs with respect to my benefits? Are my costs too high compared to my benefits? Right? Is it worth investing? Right? If my extra benefit is coming out only to 16 crores, but if my cost is 26, then it may not be worth at all for me. Right? Now let's look at it. What else are we saying? Additional staff costs. Additional staff costs are coming out to what are the new people who are recruited? 15 people extra for group B. Then 30 people extra for group C. Because there were 70 earlier already. You are making them 100. So 30 extra for group C and 100 extra for group D. So you had already 25 group B employees. So you need 40 now. So you are adding 15 more people. Similarly, you are adding 30 more group C guys and you are adding 100 more group D guys. So overall your excess cost is again around 3.6 crores. It is costing you extra for the new people. So you are recruiting another 3.6. So this is another cost, but this cost could be annual cost. Every year you may have to, because this is an annual salary. So every year you will incur this much of extra costs. Correct? This year, every year you will include this much of extra cost. And what about your maintenance? He is saying 1.4 crores is additional maintenance only. So anyhow we are considering additional cost. So your additional maintenance is this much. So now what is happening? There are no other extra benefits or extra costs. So which means you are incurring this much one time and you are getting this adjusted, this minus of these two, because these are the revenues, these two are the annual expenses. So the net is what you are left with on an annual basis. But this difference is also creating a profit. See, I will ignore the one time cost. That one time cost actually have to be depreciated. One time costs actually have to be depreciated. So let's assume a 4-year or a 5-year kind of stuff. Then you are depreciating it by some extent. So equally, let's say we are putting it over a 5-year period. Then we are saying this is the cost for the next 5 years. Let's say we are doing it over a 5-year period. So we are saying 8 lakhs, no, 80 lakhs will be the depreciation for the casino, and probably 4.5 crores is the depreciation for rooms. I'm just assuming 5 years is the period. But for considering your benefit, you will not consider the depreciation because the whole cash is going off in year 0 itself. Right? So for finding out your incremental benefit, we don't use these two. We don't use this because this is a one time. So what is happening now to make things simpler for you? If I say year 0, which is right now, after 1 year, after 2 years, after 3 years, after 4 years, after 5 years. That's how I want to look at it. So year 0, what is my cost? My cost is, right now I am putting this much of money. Right now I am putting 26.6 crores because I have to build one casino and I have to build the rooms. Immediately, this is the cost which I am incurring. After 1 year, for the next year, what is that I will get? I will get this much in revenues, but at the same time during the next 1 year, I will incur this much as expenses. So what is the thing I am left with? I will be left with this, the net increment. I am getting this minus this minus this. This is what is my net increment. The next year, I will get 11.27 crores in the next 1 year. Similarly, I will get the same in assuming that nothing is increased, no prices are increased, nothing. Every year I will get this 11.27 crores. Every year I am getting this 11.27 crores. This is what is my scenario. Now here, if there is a tax that I have to pay, that tax has to be removed. What is the tax? Tax is computed on PBT. For the PBT, probably the same process I have to follow. Whatever is the PBT process that is followed here, the total these things, I ignore all the existing ones. I will look at only the new ones. For the new ones also I have to make revenue minus the expenses and I compute the extra tax. So what is my revenues here? These are the revenues. These are the expenses. And even these will be the expenses for the computation of tax. For PBT, even this will go as a tax. I mean expense, because you are spreading the cost. Depreciation, if you remember, the way we have arrived at PBT, we have subtracted the depreciation also to arrive at the PBT. Because it's an allocation. Yeah, this is the depreciation for the two building and the casino, assuming 5 years is their life. So what is happening every year? The extra profit that is coming is this minus this minus this minus this minus this. This is the extra profit that I am getting. This is the extra profit that is coming. Every year, this is the revenue, extra revenue. These are the extra costs. I mean, this is per 1 year. 1 year, I mean, this you have spread over 5 years. 4 crores you have spread over 5 years, 80 lakhs per year. Similarly, 22.6 crores you have spread over 5 years, making it 4.52 crores per year. So per year, your profit, extra profit is going to be this much, which means per year your extra tax is going to be 35% of this. So at least another 2 crores you have to pay to the government every year extra, which means from this money, you are not getting the whole 11 every year because you are paying a 2 to the government. You are actually getting less than this. So I'll reduce it by this much amount because this much tax is going to the government. So in reality, what is that you are getting? You are getting 9.19 crores every year for the next 5 years. You are investing 26.6 crores now, but you are getting 9.19 crores per year for the next 5 years. Now, if this is the plan, but of course, here we are making another so many assumptions that I will not increase the price, right? Which in reality, probably you may see like, okay, every year if I increase the price by 10%, right? Probably what will happen to my occupancy rate, right? If the occupancy rate falls the moment I increase the price. So those kind of things, once I understand the business, I can put the numbers. But at least whatever the number he is saying, we are assuming that it will be constant for the next 5 years. So under that assumption only I am taking it. Now it's like someone is telling me you invest in proposal 1. If you go with the proposal 1, today you have to invest 26.6 crores. Wherever you want, you get that capital. You have to invest 26.6 crores. And the benefit you will be getting with that is an extra 9.1 crores for the next 5 years. Now, should this be accepted or not? Why? Okay, then that's what we'll look at it. Whether the return is there or not. No, even here itself. Okay, here there are 2 to 3 tools that are typically used to compute the return or to evaluate the returns or which project is good. One of them is called as your payback period, which is a very crude mechanism. In how many years I am getting my money back? Everything may increase. So your room tariff may increase. The cost also may increase. So, I mean, for time being, I am assuming, let that be constant. See, if you are making an assumption for increase in the room tariff, you have to increase the annual maintenance expense. You have to maintain the increase the employee cost. All will go up. So, just for evaluating at this moment, let's assume that they are fixed for 5 years. Now, the payback period mechanism, what it says is, in how many years you are getting your money back. Right? Probably if I'm looking at cumulative, in the first year I am getting some 9 lakh 1000. Right? Within the second year, by second year, I'm getting my 18 lakhs back. And probably by third year, somewhere close to the end of the third year, almost 3 full years, I'm getting my money back. Right? So that is what is my payback period. The earlier I am getting my money back, I will choose whichever out of the 1 and 2 projects, in whichever project I am getting, or in whichever proposal I am getting my money back early, that is the best one to consider. But it has so many other drawbacks. The reason is it does not take anything interest related stuff. See, it is making an assumption that getting, the 26 lakhs if I have with me, to 26 crores if I have with me today, probably I could have invested somewhere else at even 10% return. I could have, at the end of 3 years, I could have got much more. It's not just 26. Even if I take 10% per year, right, assuming I'll invest it somewhere else, even if I invest it at 10% per year for 3 years, compound interest, that is becoming 35. 35 crores. 26 crores is becoming 35 crores. Interest is 9 crores. 10% interest, 26 crores, 2.6 crores is the interest. Right? Again, there is a compounding there. So, if you just invest your money for 10% interest in a fixed deposit, you are getting 35.4 crores. Whereas in this case, right, you are talking about within 3 years I am breaking even. Because it is giving me, so don't assume there is an increase here. If you assume the increase in the revenues, you have to assume the increase in expenses also. Asset will be? We are saying is, in how many years we are breaking even. That's it. So, because it does not take the compounding and the interest and all these things into consideration, we don't go with the payback period mechanism to evaluate. There are 2 other better mechanisms to evaluate, which are called as the net present value mechanism, NPV mechanism, and internal rate of return mechanism, which is called as IRR mechanism. What they say is, whatever the amounts you are getting, you tell me what annual return you want. 10%, 12%, 15%, whatever it is. Right? It takes that interest rate into account. What is the expected return? What are you expecting as a return because of this investment? Right? When you talk about what is the return you are expecting annually, every year, on a compounded basis with this investment. Based on that, what it will do is, it will identify whether this 9 crores which you are getting after 1 year, what is the equivalent of it today? See, after 1 year, if you are getting 9 crore versus today you are getting 9 crores, there is a difference. If today you have 9 crores, probably you are investing at 15% because your expectation is 15%. If you invest it at 15%, after 1 year it could have become 10.5 crores. Now the same thing if I do the other way. If I get 9.1 crores after 1 year, if I remove the 15% out of it, what is its equivalent today? Probably 8 crores. If I invest at 15%, it would become 9.1 crores. So the equivalent of 9.1 after 1 year today is 8. Getting the difference? Like this. If I get 35 crores after 3 years, it is same as 26 crores today. If my expectation is 10%, But 25 after 3 years may be much lesser today. Right? Something into compounding at 10% for 3 years is equal to 25. So that something could be around 18 or 17 or whatever it is. Right? So what it does is, it adjusts all these numbers based on that expected interest rate and finally says overall is the project profitable or not. Now here let's say we are expecting 15% return every year out of this project, out of this kind of investment which we are making. Let's say I want a 15% return. So probably the simple way in an NPV is there is an Excel formula called NPV, which will take what is the interest rate you want and what are all the future benefits you are getting. These are the future net benefits which you are getting after 1 year, after 2 years, after 3 years. These are all the future net benefits which you are getting. It gives me that the present value of all that after removing the impact of the interest rate from them. This is what is called as a time value of money adjustment. After removing, because money has value with respect to time because of the compounding and the interest rates being applied on that. So if I remove the impact of the interest rates from it, the worth of all the 5 which you are getting, logically their worth is how much? 45 crores. But if I remove the interest from all these, their worth is 30.8 crores. Like this, if I remove the interest part from this, its worth is only 25 crores. Right? So like this, from all these 5, if I remove the interest part from it, the worth is 30 crores. Which means you are investing 26 crores, you are getting 30 crores. There is a difference which is positive, which means this is a profitable project. Which means after removing 15% expectation also, it is still profitable. So as long as after you remove the impact of the interest rate, if this number is still higher than what you are investing, it's a profitable project. As simple as this. After you NPV, what does it do is, whatever the interest rate you are specifying, it removes the impact of the interest rate from all the future benefits which you are mentioning. After removal, so after that 45 crores, after the removal of interest, it is becoming 30 crores. 30 is more than 26.6, which means it's a profitable project. Not 45 after 5 years. 9 after 1 year, 9 after 2 years, 9 after 3 years. If you want to get like that, 9 after 1, 9 after 2, 9 after 3, 9 after 4, 9 after 5. If you want to get cash like that, today you have to invest 30. Then it is 15% return. But you are investing lesser than that only. Which means you are getting much more better. You are getting a return more than 15. The IRR, what it says is, what is your overall return? Simple. Your NPV is going based on your expected return. You want 15% return. Whereas what IRR directly gives is, what is the return of this project? I mean, when you are investing 26 and you are getting 9.1 for the next 5 years, per year, what is the return? That's a very straightforward. So when I say IRR, all I give is this: today's investment and even the future benefits, including the today's investment. So it is saying 22% is the return. So because your expectation was 15 only, NPV was showing positive. If here you had put 22 instead of 15, if you had put 22 here, it would have given close to your number only, 26. You are expecting 15%, but this project is giving 22%. So if I put exactly the IRR number here instead of 22, probably if I directly point to this, because this may be an adjusted number. If I put that number, it will give me exactly 26.6. So which means my return, the project is giving me around 22% return, the first project. Now the same thing I'll evaluate with the second. So whichever the one is giving me the highest NPV or highest IRR, no. IRR is, it is talking about what is that annual return, overall annual return. It is taking compounding into consideration. And it is saying, if you invest today 26.6 and you are getting 9.1 over the next 5 years, your annual return is 22%. You are getting a annualized compounded return of 22%. Was under the expectation of 15% return. No, we have done it for 5 years. So NPV was also done for 5 years only. See, both will show the same. NPV is telling that still the excess. Oh, what is NPV is telling me that 30 crores is the worth. So there is still positive, almost 4 crores there is a difference. So which means even if I am expecting 15%, this is a profitable investment. As long as this is greater than my initial investment, as per my expectation levels, my expectation level is 15%. As per my expectation level, if this is still positive, it's a project worth accepting. Now let's do the same thing for our second project. So which will give us out of these two, which should be, so but for you to understand, the simple thing is, any capital project that we talk about, we evaluate it this way itself. You'll find out what is the lump sum cost that is involved, what are the annual costs that are involved, annual revenues that are involved, any taxes that you have to pay. Based on these things, you will find out what are your benefits for the next few years, and based on them you are finding out what is the NPV and IRR associated with your projects. Now if I see here in the second example case, again these are the numbers. The casino, you are putting 4 crores, you are investing in the second proposal case. Casino, you are investing 4 crores, which is a one time. Okay. Ayurvedic spa, you are putting another 50 lakhs, one time. Helipad, 20 lakhs. Helipad, 20 lakhs, one time. And the staff costs, they are increased by 91 lakhs. Because you are recruiting 2 B grade staff, 10 C grade staff, something. So there is an increment of 91 lakh, but this will be per every year. And additional maintenance cost is coming out to 1 crore. What is happening on your revenues? Casino is giving 25 crores of additional revenue, which is a very huge 25 crores of revenue is what, but in how many years? They have not mentioned anything about the revenue generated from a casino. This is what will bias. Alright, 25 crores is the additional revenue, that is, you invest only 4 crores, but you are getting 25 crores as the revenue from the casino, which is outright profitability. So there is nothing to analyze in the second case. So probably what we'll do is to make an analysis on this better. We will talk about 25. We'll talk about. Yeah, it's better. We'll talk about 2.5 crores. See, let's change the number. 2.5 crores per year. We will assume we will expect from a casino every year. Annual revenue of 2.5 crores. Right? If it comes 25 crores, then within no time we are profitable. No need to do this entire analysis also. So blindly you put 4 crores in the casino and you are getting 25 crores in first year itself. Probably 25 lakhs is also better rather than 2.5 crores. Yeah, let's try out 25 lakhs. After that, if things don't work out, otherwise let's keep it. And from the restaurant and coffee shop and discotheque, there is an additional 50 lakhs of revenue. And because of the room tariffs, because there is a 45% occupancy now. The rooms are not increasing, but the occupancy of the rooms has increased. So overall revenue with the new occupancy is 16.5 crores. So the incremental part is almost 1.83 crores, because initially you are getting 14.7. With the new you are getting around 16.5 crores, which means overall there is an increment of 1.8. Now let's look at year on year versus one time. Right, again the same analysis I will put. Year 0, 1, 2, 3, 4, 5. Then year 0, how much am I putting? I am putting on casino. My investment is happening on casino, Ayurvedic spa and helipad. These are my initial one-time investments. Then what about my first year? I am getting this, the rentals on casino plus restaurant plus room tariff. These are the benefits I am getting, minus the staff costs, minus additional maintenance. So every year I am getting something like 2.92 crores. So let's assume that every year I'll get the same amount. Let's assume every year I'll get the same amount. But now here what we have to do is, we have to find out depreciation for the one-time cost and then tax. Okay, what is our depreciation for this? Assuming all 5 years only. The depreciation for this is another 80 lakhs. The depreciation for this is around 10 lakhs. And the depreciation for this is around 4 lakhs. So this is my total depreciation. So what can I talk about? My revenues. Okay, revenues are, okay, I'll find out the total revenues here. My total revenues are this much, 4.83 crores. Okay, revenues minus expenses, this and this, minus total depreciation. That is what is my profit every year. These are my depreciation. So this is what is my profit every year. So on this profit I am paying 35% as the tax. So this into 35% is the tax. So from all these collections I have to remove that tax amount. So from this I am subtracting this much. which means I'm investing 4.7 crores in the first year. I'm getting 2.2 crores in each of the years. This is looking better realistic. So assume casino will give only 2.5 crores, not 25 crores. Then we would have made profit in the first year itself, super profit. So this is, let's say these are the numbers. Then what is the NPV in this case? With the same 15% expectation, what is the NPV? Is it positive or negative? 15% expectation. No, in NPV will take only the future. You will compare it with that initial investment. So this is almost 7.4 crores, right? Almost, very, very good increase, right? Almost 3 crore extra. Yeah, both are same only. Even here it was 4 crore extra. Here, what is the difference? The difference is 4.2 crores. Whereas here, it is, volume is much less. The percentage wise, it is much higher here. This is, number wise, it is only 2.7 crore. IRR will be more in this case. Though the NPV as a number is slightly lesser, IRR will be more because the size is smaller, but the returns are much higher. So in the IRR, I can find out this. 38% is the return. So probably I can say out of these two, it is looking like better go with the second. Couple of reasons also. Initial investment is also not that high. Right, only 4.67 crores of investment. Only with 4.7 crores of investment, you are able to generate 38% extra return. Right, the investment amount is much lesser. Even you don't need to raise capital big. You can probably generate it from your internal itself. Whereas in the first case, you have so much of headaches also involved. Right, you are building 100 new rooms. Here you are not doing any extra investment at all. I mean, extra new rooms, not that headache is coming up in this process. The big investment is only the casino. Oh, then probably the casino cost would have been percentage direct comparison. Whatever is your investment amount, percentage wise, you are getting 38% every year from whatever the amount you have invested. Even if I have invested 100 rupees, I am getting 138 at the end of 1 year. Whereas per 100 rupees there, I am getting 122 at the end of 1 year. Every year, see, at the end you should not look at what the amount you have invested, because you will borrow it from somewhere. Right? So that is giving you 22% benefit every year. Whereas this is giving you 38% benefit every year. Okay, I'll give you a better example. No. I'll give you a better example. Okay, you are investing 10,000 rupees and you have got 20,000, and I am telling you, you invest 10,000. I'll give you 20,000 after 2 years. Versus, there is one more investment. You invest 10 lakhs. I will give you 11 lakhs after 1 year. Which one will you prefer? You invest 10,000, I'll give you 20,000 after 1 year. You invest 10 lakhs, I'll give you 11 lakhs after 1 year. Why? Because the percentage is you are getting 100% return. Whereas in the second case, you are getting only 10% return. 10 lakhs is becoming 11 lakhs. That is the return here. So whichever the one that is giving you a higher IRR means it is actually giving you a higher annual rate of return. So you are actually investing only 4.6 crores. Probably you can use that money for something else. Right? The remaining, see, in the first one, you are investing 22.6 crores, which means your 22.6 crores is blocked in this business. Whereas in the second one, you are blocking only 4.6 crores in the business. Remaining 18 crores, you deposit somewhere else if you have that money. They will also give you some more benefit, right? Or you take up some other project. Even that will give you some benefit for the next 5 years. So if you are using the IRR mechanism, the straightforward stuff is whichever the one having the highest IRR, you prefer that kind of an assignment. In NPV, the benefit is, see, if you are looking at, see, if you don't have any other project, probably it would have been better to look at the first one itself. If you can't get any other project, right? If there are only 2 projects and you can't get a third project at all, which means your 18 whatever is lying also extra, that is idle only. In that case, I will look out for a project which is having a highest NPV. So my first project would have been the choice in that kind of a scenario, because it is giving me a value addition of 4 crores extra, but this is giving a value addition of only 2 crores, 2.7 crores. But if I think that I have many other options also and I can use that remaining 18.6 crores, 18 crores effectively, then I can still prefer the IRR kind of a method. Right?